Well, good afternoon, all. Welcome to our QuickBooks Tax Reporting class today. My name is Damon Watkins. I'm the Director of Finance and Operations for the Cal Poly Center for Innovation and Entrepreneurship. Today, we're going to be discussing a number of issues relating to tax reporting. I'm actually going to be going through a checklist for QuickBooks that we should all be utilizing for year-end close. This will ensure that we're running all the necessary reports to finalize our tax reporting within QuickBooks. We will also spend some time going through the California state requirements for your tax reporting. Not only do I want you to understand and know how to do this tax reporting in QuickBooks, but I want you to understand why we are doing it. That's a big part of this process. Do I expect you all to be CPAs by the end of this? Absolutely. There should be no doubt in anybody's mind. Joking, of course. With that said, we're going to go through the checklist. I am going to break down what the state requirements are and how we go about establishing what our rate is, where our nexus is. The key part about this presentation, before I jump into it, is I like to make it as interactive as possible. We are talking about a complex subject matter when it comes to taxes. And so the better you understand the subject matter, the more I can help you moving forward. Before we jump into this, I would like to just piggyback on something that Madison talked about. If you have not signed up to be an SBDC client, please strongly consider signing it up. They offer all their services completely free of charge from consulting perspective. And if you have a new business that you are looking to start up and need consulting in any area, please don't hesitate to reach out to the SBDC and sign up for free. Again, we provide these services completely free of charge to both our students and our local community in the hopes that we help to grow those local businesses here. With that said, let's jump right into QuickBooks. Let's just have a brief overview of what we've done to this point and what has got us to this point from a tax reporting purposes. Traditionally, I do a beginner's class for QuickBooks, which is everything from setting up and installing QuickBooks to having your chart of accounts, your customers and your vendors established. I do an intermediate course, which speaks to specifically month-to-month transactions, month-to-month closeout, banking, customer invoicing, accounts receivable, and billings. Lastly, we do this tax reporting class, which speaks specifically to year-end filings and tax report purposes. And more specifically, I will spend some time going around about the new 1099 requirements for e-filing. One of the laws that did change this year that does impact QuickBooks as a whole is that if you have more than 10 independent contractors that you will be issuing 1099s out to, you do need to file them electronically. In the past, you could go ahead into QuickBooks, set up your clients and your customers, and then just print them off and mail them in. So before we actually jump into anything else, I'm going to start at the really basic level of how do we ensure that we are actually tracking our customers at a 1099 level and that we're reporting them as 1099 customers. So I touched on this in both my previous classes. I'm going to literally spend about 5 minutes showing you guys the box to check within QuickBooks to make sure this is taking place. And then we're going to start walking through the process of what's involved in actually generating the reporting for you. And more importantly, what we should have been doing to this point. Now, with that said, if you come across something that you haven't done, don't want anybody to panic here. Part of the reason that we do this course right now is so that you can ask the right questions and more importantly, schedule the appointment with me should you need to after this class to answer any additional questions. Here's the thing about what we're going to talk about today. A lot of it is based on the sector that you operate in, right? So whether you're producing something or selling a service, taxes relate to the sector that you're in. So I will answer these questions as accurately as I can, but if we need to have more time one-on-one, I'm absolutely up to meeting with everyone and sitting down and having that understanding. Okay. So let's talk about what sales tax is as it relates to your business and when should we be accruing for it and how do we go about our reporting. Now, in most cases, if you're just starting off as a small business and you are charging taxes, you are accruing. If you are accruing, you have to be reporting. Okay, what does that mean to you? So broadly speaking, sales of services are non-taxable. Sales of materials are broadly based. Keep that in mind when you're billing a customer. Am I billing my customer for a service? Or am I billing them for a product? If it's a service, there's zero sales tax. If it's a product, there's sales tax associated. So there's a very big difference between a cleaning company and a construction company. And understanding what the relationship between those two is and what we should be accruing for is the key aspect of it. Now, in your case, we've got two different companies here. One is a product and one is a service. One is going to get taxed, one is not, okay? Why is that important? Well, there's these things called margins involved in making a product and a service. If you don't pay taxes, your margins are greater. If you pay taxes, your margins are less. And we're talking about profit margins. So all of a sudden, taxes become a part of costing as it relates to your business, okay? So things to think about, right, as it relates to QuickBooks. And so let's start off at the basic level of the most common thing that we're interacting with when it comes to QuickBooks. And we're actually going to jump into QuickBooks and take a look at this. So QuickBooks as a whole will accrue for you from a sales tax perspective, state by state by state, automatically for you, okay? It does this by looking at the zip code that is associated with the client that you're dealing with, right? Once it's identified that zip code, it can then calculate out the sales tax associated for that particular individual at that particular location. Now, the reason that this is really, really important is different states go about taxation differently. Some states have special tax requirements, New York, California, Colorado, Hawaii, that QuickBooks will account for. But the key aspect here is that they need to be set up correctly. What does that mean to me, Damon? Well, most of us are working here in California. And so we're dealing with the Board of Equalization, which is the California Department of Taxation, is called the Board of Equalization. Literally in QuickBooks, we're going to have a vendor that is labeled Board of Equalization. Because when we go to do our filings, whether it be monthly, quarterly, or annually, that's going to be the department that we are expensing this particular charge to as we move forward. Now, what if I ship out of state? Well, we repeat the same process, right? We need to register, get the same things that you did in the state of California need to take place in the other states to ensure that you are paying taxes. Key bit of advice here. Ignorance is not an excuse when it comes to taxes. I didn't know. I wasn't sure. None of those excuses fly, okay? You will get penalized, you will get fined, and you will be having to deal with the IRS on your case for the next 3 years once they get their eyes on you. So make sure you're registered in the state that you're operating in before your first sale takes place. That's number one. The IRS will shut you down faster than you can believe if you have not registered in the state. Just go ask NeoCharge, okay? Had a product, didn't register with the state, threw it on Amazon.com, sold 3 of them, got a notice from the IRS, shut them down. Why? They didn't register with the state. I didn't know. Who's the Secretary of State? Be informed. You have to be the expert as it relates to your business. That's number one. Number two, don't try to be the expert when you're not. When it comes to taxes, get a good CPA, get a good accountant to work with you, okay? Whatever they charge you is worth their weight in gold, okay? Ignorance is bliss. You guys don't know what you don't know. Now, what we're going to go through today is a high level of what we should be doing. I already know the 2 people in this room are doing it because I've been working with you, okay? But the key aspect here is as your business grows, the complexity of your tax reporting is going to grow too. Right now, it's super simple. We put these processes in place, we identify them, and we're clear about them. It's not an issue. But as your company goes, so does the complexity of what you do. That's why I referenced the California model. If we use the California model, register with your city, register with your Secretary of State, get your tax ID number. At this point in time, all these things have been done. Otherwise, you are not filing today. Okay? Really, really, really important. So, can I share? Can you see my? Can I share my screen? So I'm going to start at a really high level for you guys because we've talked about the chart of accounts extensively with meeting with you guys and in my past classes. And the reason I bring up the chart of accounts again is this where all the information ends up eventually, right? So if we're generating an invoice for a client and we're accruing for the state of California, we're going to have a line item in here specifically speaking to those tax payment. In this case, it's labeled the California Department of Taxation and Fees. And whenever I incur taxes, it's hitting this specific line item, okay? And just so you know, I'm going to show you how it gets into here and how it's set up in a moment. But the point I'm trying to make is We have one of these basically for every single state that we deal with. So right now, most of you is just California. This is where your sales tax is hitting. The nice part about it is QuickBooks keeps track of it for you and will remind you that you are due to do your filing. Now, the filing frequency is dictated by the amount dollar-wise that we have from an accrual perspective. So if we're in excess of 100,000, we're going to be filing on a quarterly basis. If we're in excess of 250,000, we're going to be filing on a monthly basis. None of you guys are there right now, right? Most of you will be filing on an annual basis, and that's why we're having this discussion today. Now, key aspect of tax reporting is making sure that we've captured everything in the system to be reported on. If you haven't invoiced a client or you haven't charged a client taxes in any way, then there's simply a zero reporting to take place. But here's the most important part, okay? The state of California will not penalize you for not filing a dollar amount on the return. They will penalize you for not filing a return. This is the belief that people have. Even if you have a zero tax return, you still need to make that filing, okay? It's the act of not filing that incurs the penalty, okay? Not the dollar amount associated with the filing. If you have a $7,000 payment due to the IRS and you can't pay it, file the $7,000 and mark it as not being able to pay it. All that's going to happen is, unfortunately, the IRS is going to charge you a little bit of interest, about 0.5% on that $7,000. Worst case scenario, you don't file the return, you don't file the $7,000, and you get a letter from the IRS saying you're going to be audited. Again, I can't emphasize this enough. It's the act of filing that's the key, not the dollar amount associated with it. Okay? Once it's set up in QuickBooks as your chart of accounts, for each separate state, we need to break out what the associated tax rate is. Now, back when I started working with QuickBooks, I'd have to go to the postoffice.com, type in the zip code, and actually calculate out each separate taxable rate. Now, when we talked about taxable rate, as an example here, 8.75, it's made up of three key components: the city, the county, and the state. The state takes the biggest, around about 5.5%, followed by the county at about 2.5%, and then the city between 1.5%. Okay, that's for all businesses inside San Luis Obispo, and it works like that for every state out there. That's how the tax rate is broken down, right? So when we actually do our filings with the BOE, we have to break that out. It wants to know, what state did you sell it in? What county did you sell it in? Huh? Really important. But if we have it set up and it knows the zip code, it's actually going to reference that zip code and go, oh, that was Santa Barbara County. Oh, that was Ventura County. Oh, that was LA County. The point being that at the end, when it comes to doing the actual reporting, the system just generates you a list and says, you spent this much tax dollars in this county, this much in this. And so the idea being that once we set it up, it just flows, right? And so what I'm actually going to go through right now is what that looks like for you guys from an invoicing perspective. Because in most cases, at least right now, and do understand, we're strictly talking about sales tax here. We're not talking about income tax, and we're not talking about payroll tax, okay? Income tax is a completely different subject matter, and specifically, you do need to get a CPA for your income tax, right? So that's your year-end final, expenses, revenue, offset, filing. Now, if you want to learn, I'm more than willing to sit down with you, but we will do those one-on-one, right? Because it's very specific to your business. Good? Okay. Bring it on. Love the questions.
General question. So like, wait, so you were saying, say we have our product and we're doing bulk orders to other businesses. If we sell to a business in LA and then we sell to a business on the East Coast, we're going to get taxed differently.
Correct.
For each of those sales.
Correct.
And we got to set up a system to keep track.
Correct.
Okay. Okay.
Correct. And that's not as long as you're aware of that very fact that you need to set up the system. Now, there's two ways to approach this. QuickBooks, vibrant atmosphere, you could set all this up. There are third-party apps that will do it for you automatically. As with anything out there, there's a fee associated with it. And they are great. I've worked with a number of them. The one I recommend the most is Avalara. Amazing product, absolutely. And assumes all liability for every invoice you generate. You never have to run about the tax returns. It takes care of everything. You're also paying for that product though, right? I highly recommend it. When I was running a $250 million budget across 20 different states with 800 employees, I used it, right? Because it was almost impossible for me to stay on top of all of that. Where you are right now, I don't think that is necessary for you guys, right? I more want you to be aware of what is your liability and what are you responsible for filing on, right? And in this case, we're specifically talking about sales tax. So for you, from a service perspective, you still need to do the filing. You still need to provide the supporting documentation, but you're going to have a nice big fat zero most of the time as it relates to you. You're a little bit different because one of the things we haven't talked about and we will talk about is resale certificates, right? Have you guys ever heard of what a resale certificate is? So a resale certificate acts as basically a tax flow through scenario. So in the United States, it's against the law to have double taxation, right? So you buy a product, you put it together and you pay taxes on all the components, right? You put the product together and then you sell it to a distributor. The distributor charges you tax, right? Buys it from you and then sells it to the consumer. Charges tax again. That's triple taxation. Okay, that's against the law. So you buy what's known as a resale certificate. You don't buy it, actually you download it. And what it basically states is that the taxes will be paid, but not by you. Why is this advantage to you and your business? Really simple. Anything you buy has no taxes on it. So all the materials that you buy, Owen, that make up whatever you're putting together do not get charged taxes. When you sell it to the wholesaler or distributor, we charge taxes at that point in time and we report it. But when you are actually buying the tangible products to put it together, there's no sales tax.
So there's no tax for the supply chain procurement people?
From the procurement perspective, correct. And that's a significant saving for you. Think about, round the numbers up. We're talking about 10% right now, right? 8.75 roughly. So that's a really great saving because what's your biggest hurdle that you have as a new business that you have to overcome? Because I tell you guys all the time, cash flow. Okay. This is just another way for you to shore up your cash flow from a tax reporting purposes in regards to how do we maximize our dollars. Go for it.
Can you just take a step back for a second and tell us what in general a small business needs to do by the end of the year? Like, is it just deal with sales tax, like file that stuff? Or
I've actually got a checklist that I'm going to walk you through that will go through everything. And so I know we've only got 3 people with us today, but everything I'm going over today, none of you need to take notes. I've got a binder that's going to come out afterwards that breaks down everything we talk about today. I'm going to jump back into the checklist in this section because this is actually the act of what I want you to do before the end of the year to put you in position to do those tax reporting. But it's, in my opinion, it's more important that you understand the concept. Why are we doing it? Not just do this. So why are you making me complete a resale certificate? How is that beneficial to me? What does that mean to me? Well, now you know. You're not paying taxes on the material. That's huge, right? It could be a significant dollar amount. I mean, when I'm working for a solar company, and we were doing one of these huge solar installations, if it was a $3.5 million installation, do 10%. Now, I know you guys aren't at $3.5 million yet, but the way you need to think about it is, does it scale? How does this work for my business overall? And the resale certificate is huge, right? It's just a way for you to mitigate and not having to incur that tax liability then. Conversely speaking, you don't have to report on it, right? You don't have to keep track of it, which is more work for you, okay? We good with that? Yeah, okay. So I'm going to take a step back into QuickBooks and show you how this process starts. So how do we actually physically generate that number that we're reporting on? How does it track in QuickBooks? And it all starts with our invoice, right? So let's go grab an invoice. Let's create one. Okay, so we have our customer up here, right? And here's our invoice number. But I'm going down to products and services, and I'm actually going to add in, we're going to do this as sales. We're going to say it's quantity of 10. I'm going to say a rate of $5. I'm going to say it's a taxable. So you notice the taxable box on here? This is where you need to be informed about what you're billing on. So what did we decide when we started this conversation? What's taxable? What's not taxable? Boom. Okay, so I know that this is a product that I'm selling, so it's taxable, right? So the very first thing the system is actually going to do is it's going to look at the customer up here. And it's going to say slow, and it's going to reference this zip code. And it's going to go out and actually ping the post office and pull that 8.75 tax rate that's due and push it all the way down here on the bottom. See it right here? Now, how did it come up with that $437? Is what you guys are going to pose to me in your head. And the answer is it referenced the zip code and it pulled the rate into the system. Now, it knows that this is for what state? What state is the hothouse in?
California.
Bingo. So within the chart of accounts, where is this going to hit? The BOE. I'm going to have one for New York. I'm going to have one for Colorado. I'm going to have one for every little state. And it's going to accrue this tax for me right here, right? So that if I go back in, you should be able to hit save on here. Where's my mouse? Why does my mouse keep disappearing? Oh, I think I have another window there. That's why. Would have helped if I put the customer in here. Let's go. Bobby Peltz Company. I listed all you guys as companies in my profile. Okay. Bada bing, bada boom. I said it's taxable, created the tax rate, gave you the total dollar amount. Now this is your accrual right here, that 437, right? If I'm going to save this right now, and we're going to go back into the chart of accounts, and it's going to be, I can get it to save. Why is it? Okay. Got it. Okay. Now, let's go back and see what this looks like from the other side of it now. All right. Right there. So the point I was trying to make about this is BOE is your reporting agency for California, right? Services, products. This is non-taxable. This is taxable, right? We created an invoice for $5,000. The system took the tax liability associated with that $5,000 and mapped it over to the BOE within the chart of accounts. And we've all got pretty familiar with the chart of accounts now. We know what it does and what the overview was. Now, let's say we go to Texas and we're selling something in Texas. We're going to do the same thing. And it's not called the BOE in Texas. It's called the Department of Taxation. I didn't see that. Taxation. Let's see if I can write. Taxation in Texas. And we create another line item for the Department of Taxation in Texas. And when we have a client in there and the system picks up on that Texas zip code, where is it going to put that accrual for taxes? It's going to put it right here. Repeat, repeat. Then when you come to do your quarterly filing, what do you have to do? You just go into your chart of accounts, look at this breakout here. Now, the nice part about QuickBooks is when we actually do this breakout, because it knows the zip code, right? It'll actually do the breakdown for you. So it'll go city, county, and then state. Okay? Go and then go.
So if you do only self-services, you don't have to do any of this.
You do not. You still have to file.
Still to file, but you'll
Still
just
have to file.
accrued zero.
Correct. Correct. As long as you don't have any materials associated. Now, anything that you're selling to the customer is what I'm saying, right? You will, you won't. You still need to file, but you won't have to create. You will. You and I will be spending some time doing just this, whether it's California, Nevada, Texas, any of it, right? This is the process. Good news is once it's set up, super easy. I mean, like as easy as pie. Like once you've got it in the chart of accounts, once you tell it it's accruing, it does it all for you automatically. You just need to know how to go about setting this up in QuickBooks, okay? And that's why I always start with the chart of accounts, because where do we always end up, guys? No matter what we talk about, whether it's profit and loss, whether it's what taxes, whether it's AP, AR, we always end up back in the chart of accounts. And so that's why I want you guys to be as familiar with that as possible, okay? High level, and then we start to drill down. So what I'm going to go through next And the idea behind this is to prompt you guys for questions to me. We're going to go through the year-end checklist. Okay. So the year-end checklist basically is everything that I need you to do before the end of the year so that we can do the reporting. Here's the deal though. You don't have to do it. Right? Because historically, you can look back in QuickBooks. It's just the time period. All that I want you to do is think about the processes of what you should be doing before the end of the year, i.e., all invoices in the system, all bills in the system. Those are the kind of things that I have to ensure to capture. If I run the report on January 1st, it's not going to make any difference as opposed to January 29th, right?
Is there any deadline?
Yeah, when you file, right? But here's what's going to happen, guys. You need to close out this year. Do you know why? Because you need to start next year, and it needs to be clean, and everything needs to be wrapped up. And how do we know that that is the case? Checklist, right? All these things we're gonna go through it super quick. And everything I'm showing you today, we're gonna go through together today, and then I'm gonna send it out to you. So again, you don't have to write anything down.
I have a couple of questions.
Yeah, bring it on.
Okay, so you said different states have different tax rates,
Tax requirements.
tax requirements.
Mhm.
So do different counties.
Correct.
So do we only have one line item per state, so how does it factor in the different rates in different counties?
Great question. 8.5% is ours right here. Zip code is 93401. Okay. Post office. So all zip codes in the United States of America are managed and tracked by the post office. All tax rate in the United States of America are dictated and tracked by post office. Bet you didn't know that. Most people don't. So it knows that this is our zip code, our Nexus zip code, right? Since it knows what the zip code is, it knows that the breakout is and 1, 7, 8, 9. Okay, so QuickBooks looks at this zip code, calls the post office and says that 8.5%, here's your breakout.
Yeah.
Okay, so you just ran an invoice for $10,000. What's 8.5% of $10,000? $850. Right? Are you with me so far?
Yeah.
Yeah? Okay, so we've got $850 in taxes here that's due. The system knows that 5.5% needs to go to the state. And it gives you a dollar amount. It knows that 2.5% needs to go to the county. It gives you a dollar amount. It knows that 0.5% goes to the city. It gives you a dollar amount. All three of these numbers total to what? Okay. You don't have to worry about this. It does it for you. When you run the report, it's going to stay the state of California, the county of Ventura, the city of Santa Barbara.
Okay.
Dollar amount. And you literally, when you go into the BO, it's a form, and you're going to go state of California, $2,000. County of Ventura, $1,600. City, $400. Ding. The system will do it. Key part is we have to have this set up for it to do it.
Okay.
Right? Because right now, that accrual that's taking place, we're accruing it in there. That's the breakout associated with it. Does that follow? Same with every other state. Whether you go now, here's where it gets a little bit complicated. So I mentioned Colorado, New York, Hawaii, right? California, you only got these three. All of those other ones, you've got special district tax, you've got school taxes, you've got use taxes. You might have all of these other ones that you need to account for as well. Okay. Best example I can give you of that. Anybody doing business in Hawaii? Okay. I love using this example because it's a great example to use. Okay. So let's say Owen sold something in California right here at the hot house, right? It's 8.75% of the $1,000, right? In Hawaii, it's 8.5% of the gross, not of the 1,000. So out here, we take the $1,000 and we charge 8.5%. That's not how it works in Hawaii. The 8.5% is built in and then it is charged, and that is called use tax. And they're the only state to do it. And the only reason they can get away with it is because they're not part of continental US, because this is considered double taxation. And they're the only state that can do it. Now, New York is another one of these ones. They don't have use tax, but they have what's known as special district taxes that you have to account for. None of which you have to worry about because QuickBooks does it all for you. But the point I'm trying to make is you want to understand how does this work? What makes up that 8.5%? I want you guys to know. Let me look up the tax code associated with that area. I'm gonna go work in, pick a state. What are you gonna want to know, guys, before you even get into the state?
Right.
What's it gonna cost me?
Right. So when you're considering where to sell, you should be considering the tax rate.
100%. And that's part of what I want you to think about. Not only do you want to think about the tax rate from a tax reporting purposes, think about this. You need to register with the state. That cost you money, didn't it?
Is that the business license?
So you need to register for the business license in the state that you're going to do business in. Yes, there's an added cost. You need to register with the state, just like you did with the Secretary of State, added costs. And then you still have to do an annual filing there, right? Additional costs. So all these things should be factored in before we make the decision to go and do business in that state, because you're going to want to account for these expenses associated with that. We good with that? That makes sense on how we came up with that number? Okay, let's go through start going through the checklist, because actually this will open up way more questions for you guys. Let's see here. Self-employed. Any questions so far? No? Okay.
So I guess another question.
Yeah, bring it on.
So there could be a benefit to selling in certain states. Is
Mhm.
there a benefit to on the procurement side? Like we said, we're not getting taxed on that. So is there any like
That is your advantage, that you're not getting taxed on
so
it.
so buying parts from Nebraska versus buying like a supplier,
Right.
it doesn't really matter.
It doesn't matter from the purchasing side other than the cost savings to you as a business. And the other one is a lot of suppliers tend to be international suppliers that you will be dealing with, not continental. And then that does play a bigger role in the taxation standpoint because you're bringing products in from out of the country. So, so as an example, and I referenced Flume and NeoCharge, both of them, a good percentage of their manufacturing happens in China before it even gets here, right? So it's produced out there, shipped out here. It's a tangible product out here, so we've got taxes, right? And they're shipping it all over the country. But that's where things get a little bit, it's treated differently because you're bringing those products in from outside the country. Conversely speaking, there are tax benefits to buying these products in the United States, right? There are releases that are their tax releases associated with different states. A good example of that would be Michigan, right? Michigan's made this huge push to become a manufacturing hub in the United States, and they offer huge sales tax and tax incentives to come and work in those states or to do business in those states. I mean, I think Michigan is the fastest growing manufacturing state in the country right now. And they promote it, they advertise it. I'm sure you guys have seen the commercials on TV, come work in Michigan or what have you. They're literally promoting it, and the way they're doing it is through taxes, right? They're lowering and saying it's cheaper and easier to come work in Michigan. You're not gonna pay as much, you get more bang for your buck, come live here and work here. And so it's taking place all over the country. So you just wanna be aware, what is it a friendly state? Is it not? I mean, like, don't take this away. You guys never wanna do business in New York. It's a freaking nightmare. I mean, the amount of permitting and taxation and tracking that you have to do, it's unreal, right? So great marketplace, but how does it impact me financially? I've got to register with state, do the filings. Again, do your due diligence when it comes to doing the business in the states that we're talking about. Okay, let's jump into the checklist.
We do have one question
Oh,
online.
perfect.
Toby asked, does every vendor on Amazon or Etsy have to register with every state they send goods to?
Does every vendor have to no, vendors do not. Vendors do not need to register for business purposes. It's on them to register as a business and complete that requirement, just like it's on you to complete yours and have your business license. So there's no responsibility or onus on you as an individual relating to the vendors that you interact with. Now, contractors are different than vendors, right? And this is something that we touched on briefly earlier on. So let's actually talk about what delineates a vendor from an independent contractor, right? So a vendor is someone traditionally that you're buying from a product or service from, and they're charging you a fee. When it comes to an independent contractor, it's just that you have a contract with an individual that is clearly defined by the scope of work, the timeline associated with that deliverable, and what they will be compensated, right? Those three define them as an independent contractor. What does that mean to you as the business owner? It means, number one, you are not responsible for any taxes associated with that individual. If that individual worked for your company and ran through payroll, we would have payroll taxes associated with it. But since he's an independent contractor, it's on him, and the onus is on him to do the filing. So here's a great example. I have an individual that I brought in. He's doing a marketing campaign. It's for $1,000. He's going to work 3 hours, and he's going to make 8 great slides that I can put out on social media, right? He does all the work. He delivers me the marketing material. I pay him his $1,000, right? From my perspective, that $1,000 is an expense to the business, number one, right? He's set up as a vendor. He required the services, and I'm paying him. At the end of the year, right, the IRS needs to claim taxes on that $1,000. But we've already decided, since he's an independent contractor, it's not on us. Why is it on him? Let's understand that part now, okay? So we're saying that $1,000, because as an independent contractor, it's his own business. He could claim the mileage that he drove from his house to the office to have that meeting. He could claim the meals that he used to meet with me to sign that contract. All of these things he can do as an independent contractor to offset against the $1,000, right? Listing all the expenses associated. But at the end of the year, when it comes to file with the IRS, it's his responsibility to file for that $1,000. How does the IRS ensure that that is taking place? Well, the answer, ladies and gentlemen, is called a 1099, right? Because when we set the vendor up in QuickBooks, we tag the vendor box that shows them as a 1099. Now, here's the key part for you guys. That is the most important part, right? If you do not generate the 1099 and send it in, the tax liability resides with you. Okay, let me say that again. If you do not generate the 1099 and send it in, that 20% roughly in tax liability that is associated with that $1,000 falls on you. Example, ride. Right? Material threshold for reporting is $600. They would never get any W-9s on file. What did a good percentage of their riders go over? $600. They were all independent contractors. What would they have to have done? Generate 1099s. If you don't have that W-9, do you know what you cannot generate? A 1099. So they know when they shut down that there were 4 individuals that they never got the 1099 from. And they are fully aware that if they get audited, they will be responsible for the taxes associated with those 4 individuals. So if you're dealing with independent contractors, make sure you get your W-9 on file, make sure it's set up correctly, and make sure it's documented. Has a significant impact from a tax reporting purpose. Here, go.
I know we've gone over it. Can you just repeat quickly what the difference between the 1099 and W-9 is?
Oh, sure. W-9 designates your social security number or the EIN number that is associated with you as an individual or a business. So a W-9 is used as a verification process against your social security number or the entity that you're running, right? The way to think about the W-9 is we all have social security numbers, right? Our business have EIN numbers. That's what creates them as an identity, as something tangible, right, for the government. The 1099 is a document showing who is responsible for paying taxes on things that you have paid for services and or products, right? So the W-9 relates to you or your social or your business's tax ID. The 1099 relates to what people are responsible for filing. So a better analogy for you would be like your W-2, right? When you get employed, you complete a W-2, number of dependents, number of that dictates how much taxes is taken out, right? 1099 is kind of the same thing, right? It's just saying that you're not responsible for filing it. The individual that received the funds is. How do we protect ourselves and ensure that's the case? We do the 1099. Okay, so traditionally when we did the 1099s, it was a 3-ply piece of paper. You kept a copy, one copy went to the IRS and one copy went to the individual, okay? That way you were always protected. You sent your copy in, he sent his copy in. That way the IRS could always verify. And this is how people get caught from an auditing perspective, right? If you're not filing, because I may work with you, right? And you pay me, you send in your 1099, I don't file. But next year they get another 1099 from you, and then the year after, and they're like, wait a minute, who is this guy that's not filing? But man, all these 1099. That's how they're able to find people and audit people, guys. Okay, that's the methodology that they use. So you can hide and not pay taxes. Eventually, they're going to find you, and eventually, going to pay. So don't. Of all the entities in all the world that you never want to mess with, the very, very top is the IRS. I'm not even joking. They're the biggest collection agency on the face of the planet.
We have quite a few questions online I'm going to jump in with real quick. First of all, Toby clarified if I'm asking, or she's asking if a business who's selling goods on Amazon, if they have to have a license to do business in the state that they are sending their goods to.
They do, and that responsibility is on them.
Okay, and then the next question is, if my business is selling via Amazon or Etsy, do I need to register in every state I'm sending products to? So.
Now that is a that is a really good question. So there is a nexus. Okay. We're going to get pretty complicated here. So first of all, are we selling a product or a service when we're talking about Amazon and Etsy?
Product.
Okay. So Amazon and Etsy actually already accrue for you from a taxation perspective. They're required to if you're registered in the state of California. So to answer her question, no. But Amazon and Etsy are one of the very few because of their size and their nexuses. If she's dealing with any other third-party entities out there, then she might. So maybe Toby, we should probably talk a little bit more so I could understand what your business actually does, because it gets a little bit more complicated.
And then there's a follow-up question. If our independent contractor is providing a service such as hauling off trash occasionally, do we have to issue a 1099?
You still issue the 1099, but the 1099 is going to be for zero, basically, because it's all service-based. And that's so that when he does his reporting, he can reflect the fact that he was only providing you a service, which in turn does not incur any tax liability. So you still generate it, you still mark him as an independent contractor, just going to have a nice big fat zero there when he receives it.
She said if we only have one independent contractor that we paid approximately $1,000 to, do we need to issue a 1099?
So you do need to issue a 1099, but you don't have to do it electronically, and you can just go down to your local Staples, buy a pack of 1099s for $12, print one off, keep the rest in your drawer, mail it in, and be done.
Okay, thank you.
Welcome. I love these questions. Yes.
So whenever an independent contractor makes less than $600 from you in a given year, you don't need to send it to them.
I'm going to give you the same advice that I gave, right? Because this is the argument they had with me. Damon, they're not going to get $600. And I was like, okay, let's do the numbers here. Are you going to tell me that 100% of all your people are not? Oh yeah, we're going to shout out. Guess what happened?
More.
Okay, so what's the rule of thumb? What am I going to? What's my answer going to be?
Always make it 1099.
Always. If you're dealing with an independent contractor, always get that W-9 on file to
So-
protect you.
So we've been getting W-9s on file
Perfect.
the whole time, and in QuickBooks pressing track 1099s, but then if the end of the year comes and they haven't made $600, then we still send them a 1099 anyway?
So great question again. I send a 1099 to everyone. I don't care if you made 2 cents. Okay. If I'm going to do it, I may as well just do it. Right. And then you're protected. Right. And it's not like you're not tracking it and you're going to do additional work. It's just a button.
Yeah.
And it's just going to. So first of all, any independent contractor I deal with, I get his W-9 on file. And any independent contractor I deal with, I send them a 1099. Because here's the thing, it's not making more work. And what did you just do? Protect yourself. You don't have anything to worry about. You don't have to worry about maybe that guy come back and you know what? Yeah, what? I already sent you 1099. Don't worry about it. Take it off your plate, make it part of your process, because it ended up making a ton of work for Ride. Because they had to chase these people and they were so concerned, and it just, like I said, just get it on. And they were like, well, what if we can't then don't pay them. If they don't want to provide you a W-9, don't pay them. I cannot pay you until, if I don't complete the W-2, guess what? I don't get done by Cal Poly. I don't get paid. You know, you are in control of your business. You know, they would say, well, they're driving and they don't want to come. Okay, tell them they're not working anymore. You're not driving anymore.
And they're not going to even get taxed on that anyway, because
No,
it's a service, right?
correct.
Okay, so it doesn't hurt them whatsoever.
It doesn't hurt them whatsoever, but informing them of this fact and keeping them up to date so they understand that. Again, I hate to tell you this, guys, but you have to be the experts when it comes to your business and what you do. You're going to meet with all these smart people that can give you great advice about their world and how it relates to you. But you guys are the expert. This is your business. Nobody knows it better. And I can sit here and I can tell you all this stuff and you can go, yeah, but none of this relates to me. Or you can go, oh my God, dude, I got to get on top of this. This could have a significant impact on how I manage my finances. So that's the mentality you want to have when it comes to, here's the thing about taxes, just don't hide from it, right? Part of what I'm trying to do here and why I'm not sitting in QuickBooks is that it's not this super complicated, unbelievable thing. Here's a lesson I'll tell you. Do your own taxes just once. You'll never have a CPA do it again. Do you know why? Because it's stinking easy. Every question is right here. Do you know what happens? You see 3 pages and 90 questions and you go, you do. I've watched every person in the world, but just go through that page and go, oh yeah, no, yes, $20. No, yes, but at the end of it, you will know all your personal finances. You will know how to do your taxes, and it's not that complicated. It's not complicated. 8.5% made up of city, county, and state. Not hard. 1099s, make sure we're accruing. Not hard. Sales tax, broken out, file quarterly. Not hard. Structure. We need the structure to be successful. And that's why we kind of build this like Legos, where we start with the base, chart of accounts, vendors, customers, bank. And then we move on. Taxes, reporting, accruals, all the, and we build. It's not hard, but we need to understand it to be able to work with it. And that's what I want. I don't want this to be this mythical thing. Taxes, oh my God, it's so scary. No, not really. I mean, if we understand it, we have a process behind it, it's pretty clear. I'm spouting now. Go for it.
This is a really small, just practical thing, but is there a certain way that you keep track of all the W-9s? Like for us, we do, you know, it's like Adobe DocuSign, but then we collect them and we're like uploading it or like typing in all the information in QuickBooks. Is there an easier way where you can just have the W-9 like automatically filed in QuickBooks or something like that?
No, I mean, what I do is I attach everything within QuickBooks so that it's all right there, but there's no easier process. You've got to manually do it. And so what I normally traditionally when I was doing it is I'd make a day for onboarding. Like Tuesday would be my onboarding day, where I'd accrue all of them, put them all in the system on one day, because it is a little bit time consuming to enter them all. But once you've entered it and you've tagged the W-9 to the file and saved it, that's it. There's nothing else you need to do. Like if I was your CPA and I said, okay, send me your account file, it'll all be there. The file would be there, the documentation, there's nothing. It is labor intensive. There's no 2 ways about it. Setting these individuals up takes time. Student interns. You know what I mean? And your time is valuable too. We're going to talk about that a lot the more we meet. Your time has a real value component to it that you guys tend to underestimate. That's why you try to do everything. You guys are going to get to the point pretty quickly, much like Sean did, where you're not. And your time becomes more valuable to hire someone to do these things so that you can focus on growing a business, right? And you all get there and you all delay doing it and it all bites you in the ass. Every single one of you, okay? Because it's human nature, right? You bootstrapped, you kind of got yourself into this point, but to take that next step at the best of times, you guys have to go, yeah, I need to put more time doing this, not say this, right? This is where you get an intern who's from OCOP, finance guy, and you say, go sit with Damon, figure this stuff out for me, and then do it every month. And I'm going to sit Damon and talk. Done, right? You know at a high level what's taking place. I work with him to make sure it's done in there. Good to go. He makes $15 an hour. It's a business expense. And your time is worth 3 times that amount when you're building a business. And you need to think about that. Yeah? Okay, let's get to the checklist because you'll actually have more questions for me once I get into this checklist. If I can find it. Let's see. We good on questions, ma'am?
Yeah, but it looks like, oh, actually we have one. Toby said, I just recently became a client. I need to learn how to do my own books, monthly closeouts, etc. I currently have a bookkeeper, but would like to bring that function in-house to reduce overhead costs for my business. I also need to pull payroll processing in-house.
Boom, love it. Is
I
that Toby?
I need a new bookkeeper in the local area. My current bookkeeper is in Texas and I occasionally struggle with them. Yes, this is Toby.
Fantastic. Toby, here's what I'm going to recommend. We should sit down together next week and have a further conversation. Everything that you're talking about, we can help you with and assist you with, from bringing the functions in-house to a monthly review to setting up payroll. Once I'm done with this session today, I will send out an email summarizing everything with the associated documents. If you just want to respond to me and we can set up an appointment. Is Toby a client at this point in time? Fantastic. So we are halfway there. And then Toby, we can either do a Zoom call or we can meet in person, either which one works really well, but we can go through everything you just talked about, and that's not a problem at all. In fact, it's the funnest part of what I do. Okay. QuickBooks Self-Employment Guide. Let me share this so we can all see. Love this little checklist. Okay, so high level, this is literally going to walk you through every single step that you need to do to close out your books financially, right? Here's the good news. Half of it you don't need to do, okay? Because you're not there yet. But here's what I want you to do. I still want you to go through this process because I want you to think about it. What you're doing this year will not be the same as what you're doing next year, okay? Next year, you make that big jump where you actually become the business and start reporting and doing these things. I need you to start thinking about this right now, right? Because this will start to get the wheels turning in your head and what should I be tracking? What should I be setting up? We just talked about all of this. None of this happens if it's set up correctly in QuickBooks, right? The BOE, the accruals, all of that. Same with the checklist for the end of the year. Now, here's what we're going to do. We're going to walk through the checklist. As you come across questions that you want to ask me about it, keep it in the context of how it relates to your business, because some of it will relate, some of it won't. We good with that? Again, service, product is what I'm talking about here. Okay. Question?
Oh, just stretching.
No.
Sorry.
Okay, so most common one, and I know you're already doing this because we meet and talk about just reviewing your bank transactions, right? If we're going to close out the year, all transactions from both a revenue and an expense side need to be captured. There should be 0 transactions relating to this year, right, as we get into January. All of them should be racked up. All of them should be coded. There should be nothing outstanding. Why? Well, when we reconcile, which we are doing on a monthly basis, we will not be able to tie out unless we have that. Okay, so number one, we will not be able to tie out the year. Make sure our banking transactions are all coded correctly and are all tied out. Good with that? Simple, pretty concise. Okay. I'm going to touch on credit cards. I know neither of you. A lot of my clients have credit cards in here. You need to account for your credit card expenses. Now, most cases, the question that comes back to me, but Damon, the payment to the credit card doesn't go through until January. That's fine. I need the expenses captured in the year that they took place. Really, really important. We spent a lot of time in my beginning class talking about capturing the expenses in the month that they take place. It's also really important to capture the expenses in the year that they take place, okay? So even though you're only paying the card down in the following year, the expenses actually took place this year. That's where they need to be captured. We good with that? Pretty straightforward. Okay, double check your tax profile. Well, we just spent 45 minutes talking about your tax. This is your tax profile. It's that line item within the chart of accounts that is tracking the tax accrual, right, as you enter those invoices. So the system knows California, 8.5%, $437 tagged in there, repeat, get to the end of the quarter, log into BOE, do all filing, broken out right in front of us. Good with that? Okay. Here's my favorite one. Review your mileage, okay? Biggest mistake businesses make in their first year. They don't capture what? All Oh, thank you. I did repeat it enough times. Biggest issue, right? And why do you guys do it? Oh, I won't put the expenses in my business. I'm going to take this. This is on me, dude. I got this. My company. I got this, right? And what did we decide in my last 2 classes? That's terrible. Okay. Why are you, what, you're shooting yourself in the foot, because what is that expense to your business? It's an offset to income and taxes. Yeah. Right. I make $1,000. I got 0 expenses. I'm paying taxes on $1,000. I got $300 in expenses. I'm only paying taxes on $700. You have to keep that in your mind. So mileage is a big one, right? Because we don't think about it as a business expense. So Owen goes to meet a client, goes to meet a consultant about the business, not even a customer. He wants to talk about the dermal patch and what it's going to take and manufacturing it. And he drives all the way down to Ventura. He has a great lunch with this consultant, and he drives back. In your mind, you're going to go, that's not business. I met a consultant. Right? I mean, like, if I didn't get any sales out of it. No, it's a business expense. You should have the mileage. You should have the lunch. You should have it in the system. Boom, offset. Okay. You have to get past that. You have to get past that.
So how do you track mileage in QuickBooks?
Oh, great. Okay. So QuickBooks actually has an app in it, built into it on the mobile version, that will let you track it by the individual. And I actually really, really like it. So Sam, in your case, you can have the QuickBooks Online installed on your phone. When you walk out this door, you can click a button saying, I'm going to a meeting. It will track when you left here, how long it took you to get there, how far you traveled, right? I'm a big fan of the mileage tracking app that comes with QuickBooks Online and the remote app that you can do. That's number 1. I'm going to give you option 2, because not everyone's technology savvy, right? And whether it's dealing with an independent contractor or one of your staff, right? Not all of them are going to do that. They're not going to put the app on the phone. I would make them Google. So most cases, employees want to be, if it's not you, want to be reimbursed for the mileage associated, which is a business expense. So I would ask them for 2 things. I would ask them for the Google map showing the distance that they traveled. So I left from here to here and came back, and then the time. How much time did you spend? With those 2 components, I can create a reimbursable to that individual. You drove 40 miles, 65 cents a mile. You had lunch. I'm going to reimburse you for all of that. All of it's an expense. All of it is categorized. All of it is an offset to your sales tax.
So you would recommend reimbursing ourselves for mileage that we bought?
Absolutely. Absolutely.
But not going to work. Right?
Not going to work. So here's the deal. Getting here is not an expense. Everything after you get here is an expense. So the moment you get here, the clock starts. The moment you walk out that door, that's all an expense. Whether you drive down to Ralph's and buy toilet paper, or you drive down to Staples, or you drive down to LA and meet with the biggest investor you've ever met with. Getting here is not an expense. Everything after that is.
So like something like tonight is like a mixer thing at somebody's house. They're driving there would that be?
So how does that relate to your business? How is that a business expense? Is what I want to know.
Well, I don't know if it is, because it was like from Judy, like and it's like somebody related to CIE. It's kind of just like a networking thing.
So here's the thing. You're going to have to check with the boss. Okay. Do you know who the boss is? Because I'm looking at him. You need to decide. This is your business, Owen. You can go out and buy a car tomorrow and write the entire car off against your business because you drive it every day to work. And that is completely legit and legal to do. And that's fine. Here's what I'm going to say to you. Be consistent.
Be consistent. Yeah.
Bar none. Because that's what they look for. The IRS looks for from an audit perspective, is when you're not being consistent. So if you're asking my professional opinion, no. I don't consider networking events to be a business expense. That's just me. That's me. Now, are there other people out there that claim it as a business expense and they don't? Yeah, absolutely. So I'm not telling you not to do it. All I'm saying to you is I personally don't. Now, if I was meeting Judy to discuss your business tonight,
Sure.
Different scenario.
Sure.
But I don't, and again,
That's what I was thinking.
yeah. So again, this is where it becomes your judgment call. It's your business. You get to choose how to do it. Be smart and be consistent is what I tell everyone. Okay. Because that's what the IRS is looking out for. Make sense? Yeah. Okay. So mileage is a big one. Okay. And on top of mileage, I just want to put out there, meals are expenses when it relates to business. If you're meeting with someone as it relates to your business and you're eating something, that's a reimbursable to you. It's an expense. Capture it. Do yourselves a favor. Okay. To claim mileage, I just want to reiterate this because this does change each year and it's something you need to stay on top of. So the aggregated mileage rate that you reimburse is dictated by the state and it changes every year. It's your responsibility to stay on top of that information. So I normally have a little checklist on the 1st of January that I go through. This is one of the items that I make sure that I'm up on top on because that does affect the rate that we reimburse people at. Again, ignorance is never an excuse, guys. You need to stay on top of it. You need to choose to be informed when it comes to these things. Your vehicle info is needed to be kept up to date. To claim vehicle expenses, check and update your QuickBooks for your profile as needed and your account settings. Here's one thing I would emphasize to you, okay? Who's an example that I can use? Flume. So Flume came to me 2 years ago and they wanted to buy a car, right? But they didn't know how they could pay for it. And I said, well, what are we going to use the car for? And they said, well, we want to buy a Tesla. We want to buy a used one so that when we go to these events, we're showing up in an electric car. Right now, they're driving the Toyota little thing. And he's like, no, that just doesn't pitch well. But kind of don't have the money right now to do it. But it would be so great if we could do it because we could get the car, we could put our logo on when we go to these events. And I was like, okay, you don't need to come up with the money. Let's just lease the car and write it off as an expense each month. Wait, what? We can do that? Oh, yeah. So what do we need to come up with? We don't need to come up with the 40 grand. I'm like, no, you just need to come up with the down payment on the lease. Well, what's that? That's $3,000. Oh, we got that. So for the last 2 years, they've been leasing a Tesla that they take to all their events. And guess what? It's 100% business write-off. The expense hits the business, it comes off. So you can be smart in how you, now, did they have the 40 grand? No, they didn't, but they found a way to leverage having their own business to purchase a vehicle or lease a vehicle in this case that they used for marketing expenses. So the registration for the car is written off. The maintenance for the car is written off. They take a percentage of it to their marketing campaign because they put their logo on it and drive around everywhere. How much do they pay for this car out of their pocket personally? Right? So an example for someone like you, say your business grows to the point where you're visiting a lot of these cities. You don't want to track that mileage. You lease a car. The lease car payment is written off. It's about being creative in the way that you go about understanding the relationship between expenses and your business and taxes and leveraging both. We can catch up later. Don't worry about it. I'll make time for you. It's not a problem at all.
Yeah, I'll see you tomorrow.
Yeah, we've got our standing, so let me know.
Yeah.
Okay, sorry, I really think it's important we get through this checklist because it will really help everyone. And Toby, please don't hesitate to stop me along the way if I'm not answering anything else that that might pop up on your side of the world. So record your business assets. This tends to be a big one, okay? Now, why do we want to record and track our business assets? Well, over a period of time, we can amortize those assets out, right? And use them as an expense against the business. So depending on what your material threshold that you've established in your business, right? So as an example, any asset that we buy here at the Hot House over $500, I list as an asset and I amortize it out and we depreciate over a period of time. The most common one would be a laptop, like what I got right here. So I buy this laptop and most of my laptops I amortize over a 3-year period. So the business claims the expense. I paid $1,000 for this laptop. Each year I claim a $330 expense against the business. After 3 years, this laptop is completely devalued. And then I can go out and repeat the process. But that expense is hitting the business. It's an offset against what we're filing. So your MacBook, your monitor. I create a material threshold, so I'm not doing it for everything. Otherwise, I'd be doing it for a calculator. And that's why I dictate that $500 mark. It can be different for any business out there, right? So you may choose 1,000, you may choose 5,000. It's honestly what that material threshold, okay? One point I want to make clear here, the difference between a lease and a purchase. With a lease, you can write off the lease payment. With a purchase, you can claim the amortization amount against the product. So if he bought the Tesla outright and wanted to amortize it over 5 years at $40,000, it'd be $8,000 a year. He'd be able to write off against the business. So assets are important because they enable us to create a write-off against our businesses from an expense standpoint. So, and actually it explains it better than I even said. It says assets aren't like standard expenses. They usually last a long time, more than a year, tend to be a larger purchase, $200 plus. I use the $500 model, and are exclusively for your business. Examples of business assets are manufacturing equipment, cash registers, computers, tools. Ensure your business assets are categorized as business assets in QuickBooks. Again, I'll emphasize this. Cars, vehicles are considered assets in this area. Okay. Last of this subsection of this list is import missing transaction. If you accounted for every expense and source of income throughout the calendar year, it never hurts to check at any 2019, in this case, 2023 transactions that you have not recorded into QuickBooks and self-employed, especially if you started using the product after the start of the new year. If you paid cash for any business expenses or assets, be sure to add them manually. Here's the good part about the people sitting in this room. You do not need to do this. You do not need to worry about this. The reason I know this for a fact, I can't speak to you, Toby, but I know that you reconcile your books each month because I make you do it. And if I make you do it, there's no way that you would be missing a transaction because we're tied directly to the bank. Toby, when we sit down, this is something I can go through with you and go into a bit more detail about. But as long as you're reconciling and tying back to the bank each month, this issue will never arise. So not something you need to worry about. We good with that so far? We'll keep going. Okay. I'm going to speak to this section really briefly because the only thing I really need you to be aware of about this page is your 1099s, right? So if you're expecting a 1099 from a client or employer, the business has until January 31st to postmark or e-file the form. We encourage you to double check with your employers to ensure. After we get through this checklist, I'm going to jump in and show you what do you have more than 10 subcontractors? I know Toby said, no. Well, then I'm not going to show you because honestly, you don't need to know it then. But basically just keep in mind moving forward that if you do have more than 10, they have to be done electronically. Trust me, it's still so much easier to do it paper-wise if you ask me, and you don't have to worry about it. It's just walk down to Staples, walk in, order them, be done, and walk out. Lastly, but not leastly, I like to run year-end reports. Why do I like to run year-end reports? Well, because things happen, right? So the key one that I like to run is the tax summary detail and the transaction history detail. The reason these two in particular, I'm not as a big fan of the receipt report. And the reason for that is the receipt report only shows you receiving payments directly received in that hit the bank account. The transaction history report will actually show you more detail, as will the tax summary and the tax detail report. It'll show the accruals, et cetera, et cetera. Mileage is another one. And the only reason I bring up the mileage again is to ensure that you've captured your mileage for each month from an expense standpoint, right? I tend to create a document called year-end close, and I download every single one of these into it, irrespective of whether I'm going to utilize the document or not. It is a reference point. It gives you good knowledge knowing that you have those documents on hand. Here's the thing, you can go into next year and they're still going to be available to you. But here's why we actually run this report, and I'll give you a great example, okay? And it's going to happen to one of the three of you because the numbers say it. You're going to close out the year, you're going to get right into January, you're going to blow through January, and you're going to be in February. And all of a sudden in February, you're going to get a bill from Home Depot. You purchased this in November of last year, and you forgot to pay us. And we're sending you another copy of the invoice. And you go, oh my goodness, get back into November of last year. There's your invoice. You're paid. Bing. What just happened to the year-end or closeout? You just threw it all the way off. Every single transaction from that one that you went back to would then be thrown off moving forward. Guess what you've got, though? You've got all your transaction reports available before that entry. So just as a mind reference, having these documents available, here's the other part. If you're working with a CPA, this is exactly what he needs to see. You actually don't need to generate anything else for him from a tax reporting purposes if you generate those forms. Now, lastly but not least, I do want to emphasize that QuickBooks Online does have the ability to have what's known as an accountant copy. So a lot of the time when I work with you guys and we're talking about taxes, I will ask you to send me an accountant's copy. It basically just gives me another level of insight from a granular detail perspective as to what's taking place. Okay, fantastic if you have a CPA that you work with, You can send these files back and forth very easily. You can review them for you. He can let you know what you want to do. Goes back into QuickBooks, super simple. Basically what I do. Okay, actually gets right there down to the bottom. That's the accountant copy return.
We do have one question. Or a couple
Perfect.
questions.
Love it.
Toby said, I'm currently not showing any expense for my time. Should I be?
Yes, definitely.
Okay.
So this is another area of weakness traditionally within new startups is that it's funny because I literally just 10 minutes ago said to Owen that there's a value component to your time. And the reason I bring this up is that we don't always associate our time and effort with the product or service that we're providing, but it is an expense to the business. So, and Toby, I love your question because it actually leads me down another path. The question I'm going to pose to you right now is, are you actually paying yourself? Are you running yourself through payroll? Are you taking an owner's drawer? And all of these questions relate to what you just asked me in the way that we go about it. What was the follow-up on that?
The follow-up question is, I haven't been tracking mileage, but have been using the business debit card for gas and tires. So those expenses have been captured.
You just need
I
to
don't
enter.
plan on expensing mileage this year since I didn't track it, but I will going forward. Does that sound reasonable?
Absolutely perfect. Yeah. And the thing Toby, you and I are going to have a great conversation when we sit down. So first of all, you hit on the fact that you have a business credit card that you're charging it against when you do use it. So if I was you, I would just go back and pull those expenses in for yourself. And I will even help you do that if you need some help with it. The very fact that you're tracking your business expenses and your personal expenses separately makes your life that much easier. It's the single most important rule when I'm working with these accelerators is I'm like, go open an account and keep your personal and your business completely separate. No, I'm not taking any money out this time. Okay, we should probably talk about that because most people perceive that as the owner of a business, the only way you can pay yourself is to run through payroll. We don't like payroll. Payroll taxes, FICA, all that stuff. You can do what's known as an owner drawer where you take taxes, where you take funds out of your business without having to pay taxes now. We deal with it at the end of the year when we deal with your CPA. The nice part about that is we can use the expenses that we've had to create offsets for you. So again, understanding your business a bit better and what have you, these are kind of some of the discussions that we can have. Good? There's no money to take out yet. We aren't making profit. Well, we'll get you there so that you can.
So if you're not paying yourself and you're not planning on paying yourself for this year, you don't need to put anything in about your time.
No, but you should be tracking your time. You're actually, and so we get into something called project accounting, right? And fund accounting when we look at this. And so I deal in the world of what's known as fund accounting. And I'm just going to give you a brief overview of what that means, but can I show my time as an expense? Yeah, you just need to track it as an expense. So you need to give yourself a dollar amount per hour associated with the job that you do. And then you need to enter it into the system to track it as an expense. Now, the only byproduct of that is it does mean you're going to have to pay yourself that expense. And this is where it gets a little different. So we can incur the expense and create the offset by utilizing what's known as an owner drawer. But if you only enter the expense and choose not to pay yourself, it is an expense to the business per se. I don't know if I made that more complicated in the way that I explained it.
So would you recommend doing something for that?
I would, and I would, in your case, even more so because you're more project-based. Okay, let's talk about fund accounting, project-based accounting. Yes, I'm wanting to show you. Okay, yeah, no, we can definitely do that, Toby. So in total, I manage 17 grants for the CIE, right? Across those grants, all of you guys are employed. You hit those grants at different areas and different percentages. That's called fund accounting, right? And it's dictated by what's known as a percentage of effort. So I look at everybody that works here and I associate a percentage across 17 different grants that they hit from a payroll perspective. In many ways, you do the same thing with your social spark and these little get-togethers that we do, because each one of them is a project unto itself, and each one of them you commit 4 hours of time to set it up. That's an expense to each one of those projects as we set them up. And so much like Toby's saying, how do I capture that expense associated with my time? Because it does have a dollar associated and it is an expense to the business. Now, traditionally, you would be paying yourself through payroll and that's how this would be captured. But at this point in time, we want to capture the expense. We're not so concerned about paying ourselves, but we do want to capture that expense associated with it. And here's why it's really, 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 really important. If you're not capturing the expense, when you're pricing for either the service or the product that you're doing, guess what you're not accounting for? You, your time, and your effort in providing that. And it does have a tangible dollar amount associated. The tricky part is figuring out what is that dollar amount, okay? And so that's why we go through a lot of these processes. But yes, both in your case, and I would want to understand a little bit more about Toby's, but absolutely your time and anybody else's time associated with time and effort for work should be captured.
So how do you set that up and create an office?
Yeah, so this is your situation be a little bit different. I would capture you as see, I wouldn't want to run you through payroll, but what I would probably do is then set you up as a contractor for your own business right now to capture that expense associated with that time. Only right now because of where you're at. Because you're not taking a drawer, you're not taking, you're going to get a 1099, but it's going to be for zero.
So set yourself up as a contractor, but just say you're paying yourself zero?
So no, incur the expense, just don't pay yourself back. So you can incur the expense. So it's like getting a bill from PG&E and not paying it. Do you have the expense from PG&E? Yeah, got the bill.
We would just kind of have like an outstanding bill.
Correct. And so at the end of the year, and this is where I was going to get with Toby, right? At the end of the year, if we've incurred all this expense, so let's say 40 grand, but we've never paid ourselves, we can use that as an offset. We just need to document it, and we need to be consistent in the way that we go about it. Now, I'm recommending you do it that way now. That would not be the way I recommend you do it next year, right? Because your business will have shifted by then, and that model will have changed as well. And we will probably be looking at project-based accounting because each one of your events needs to be broken out separately so we could track it. We can track the costs associated. We can track the revenue associated with it, right? And again, this is why I want to sit down with Toby so I can understand hers a little better and create that structure around it. Yeah?
Yeah.
Okay. I can see the wheels are turning in your head. I love it, just so you know. I touched on have the accountant who files your return. They can essentially get an email with all the reports that are necessary for us to complete the filing. Special notes about TurboTax. I'm actually a big fan of TurboTax. If anybody's interested, you do get a discount through Intuit if you have QuickBooks already. If you want to learn how to do your own taxes, TurboTax is a great place to start. Okay. Choose to be informed. Choose to be the expert when it comes to your business. You don't need to know everything, but you need to know what pertains to your business. That's it for our checklist. Okay, pretty straightforward. If you do everything that I just spoke about, you will have no issues closing out. The other key component about this that I would say, and I touched on it before, is you have to reconcile your books. Okay, all of this is only possible if we've been reconciling it back to the bank account, tying it out each month, and closing it out. All of this comes together if that's taking place. If that's not taking place, and we don't have the structure to accrue for our tax reporting, we're going to be up shit's creek. Take the time to do it right, get it set up right, and most importantly, ask the questions to make sure that that's taking place. Yeah? Okay. Toby, ask me some questions, please. I want to make sure that I'm clearly getting all of your questions answered today. Okay, so I got through the checklist. I want to go back and actually go through the tax reporting one now for you guys. No questions, Toby? No? Okay. Okay. Okay, so now I should be able to share this. Oh, is there two more questions? Oh, those are the old ones. Ah. See if I can get into this now. There we go. Okay. So I actually wanted to go through and take a look at major and customized one-time file sales tax. Perfect. Okay. So the one section I just want to touch on here, and chapter 11, it's like 2 lines in there. But one of the questions that comes up a lot of the time when it comes to closing out the year and reconciling from a filing taxes is I get a lot of questions about journals in QuickBooks. Okay. And this is a big one. Okay. And I'm not speaking to you guys right now as the QuickBooks Pro guy. I'm actually speaking to you guys as the accountant / CPA that I am. Because nothing creates more headaches for me working with clients than journals. Nothing creates more heartache and headache for me when it comes to taxes than journals. And here's why, okay? When you do a journal in QuickBooks, there is no record of why you did your journal in QuickBooks. And let's understand what a journal is, okay? And journal is a moving of an expense related item. It can be income, it can be revenue, it can be expenses that we want to move to a specific category code, but we cannot do it through a transaction. So I can't facilitate that taking place by either AR, AP, or some other method. So what we do is we create a journal. This journal enables us to move that associated position and put it where we need it to go. The reason I hate it is it has nothing to do with accounting. Okay, it's simply taking a peg and moving it from one spot to another. Here's my recommendation. If you're going to do journals in QuickBooks, please create for me a journal log. I need 3 pieces of information. Where it's going from, where it's going to, and why. I cannot tell you how much time and how much your CPA will love you if you have a journal log that goes along when you do your filing submissions. Because literally from my world, when I look at your chart of accounts and I see these journals, it gives me nothing other than a dollar amount. Well, why did you move that $5,000? Was it a contractor? Was it an employee? Was it an expense for some? What was it? I have no idea other than their journal log. And this comes up at this time of the year because you've been doing them throughout the years for whatever reason. And just so you know, I will not teach anybody how to do a journal. I absolutely flat out refuse to. Because all it does at the end of the day is end up making me more work. If you want one done, come to me. I will give you a process to get it done without doing a journal, or I will do the journal for you, okay? Putting yourself down this rabbit hole when it comes to journals, especially at this time of year, as it relates to tax filing, can be a nightmare. So don't do it, okay? If you have a question, come to somebody who knows, ask the right question, so we're not putting ourselves in these positions, okay? I can't emphasize this enough. I spend so much of my time tracing things that if we had simply documented it, would not be a problem. Okay. The journal one's a big one too, because it creates a lot of issues within QuickBooks if it's not done correctly. That's all I got, guys. Pretty straightforward. So I was going to show you how to do the e-file 1099s online, but since neither of you have any, I don't even want to give you that headache or heartache. I'm hoping that today was productive for you guys. I tried to make this more of an interactive session as opposed to me just clicking through QuickBooks and talking about things. With that said, Toby and Sam, please give me feedback on my sessions, what I could be doing more of and what I could be doing better. And lastly, but not leastly, Toby, I would love to set up an appointment with you, whether it be in person or via Zoom. Both work for me.
She is wanting to meet in person. I'll have you guys coordinate as far as what she needs prepared.
Perfect. Perfect. I love it. I love it. That would be absolutely fantastic. And I'm free next week. My schedule's pretty free, Toby. So we can definitely make a plan next week to get together. Open session for questions. Ask me anything you want right now as it relates to QuickBooks and taxes. And anything else that I don't address today, feel free to email me once I send the follow-up email out after this session. Again, I will provide the study guide to you along with the checklist. So once you take a closer look at it, if you have any questions, concern, don't hesitate to reach out to my email address and respond. Good? Yeah?
I mean, I have more questions.
Love it. Bring it on.
Okay, well, going back to the part of accounting for my time as an expense, as an independent contractor.
Mhm.
So would you recommend just picking a somewhat justifiable, like hourly rate and guessing the number of hours I work, creating a bill, but leaving it unpaid and then just leaving it at that, or is there more?
So no to all the above.
No to all the above.
So
okay.
first of all, you need to come up with a dollar amount rate that you are going to charge yourself as the CEO of a business, okay? And it needs to be a reasonable rate, okay? So $30 an hour, fine. You are then going to track your hours, madam. You're not going to make up a number. You're not going to fiddle it. You're going to know, and I know that you know what you worked and how much time and effort you put in. Now, the key part about this, though, right, is it has to be time associated with service or product, not time you building your company. Okay, it has to be associated with work associated with a product or service. So again, and this is where the gray area starts to come in, because I'm going to throw one out to you that I get all the time. Well, I got a sales guy who's calling 9 hours a day. Okay, great. Yeah, sure. He's a marketing guy. You can charge that as a business expense. Absolutely. But he didn't get any sales. Doesn't matter. You're still paying him, right, for that time. Well, no, I'm actually not paying him. He's on commission. Oh, okay. Then, okay, so now this is where it starts to get caught. And the reason I'm bringing this up is I want you to think about this from that perspective, because we start to drill down and drill down and drill down and drill down. So come up with a rate that works for you. Track your hours and enter the monthly as a single line expense. I worked 80 hours this month. I worked 120 hours at $40 an hour. Boom.
So for this year,
Mhm.
I'm going back the past couple months.
You're going to go back to June or even further because but roughly.
And
okay.
When you're saying, so you're saying marketing hours count.
Marketing hours count.
Marketing hours and probably like things related to organizing the service.
Organizing the service or operating the business per se.
Okay, so operating the business.
Operating the business is still considered an expense. I mean, in most cases, you're going to be able to get a full 8 hours out of it. I'm not sure the difference between building a business and owning a business. Can you talk a little bit more about that? Yeah. So it's a really good question, Toby, just because it's actually really what you're asking me. Okay, so we talked about project-based accounting, right? Which is where we started with this whole conversation in regards to your business and growing your business as a whole. Anything that can be claimed against that particular project in your time and your effort should, right? And the reason I'm going to bring this up is it's going to break out into 2 core segments. So, and I'm going to use Sam as a reference point here, Toby, but tell me if it works in your world as well. So Sam's working on 5 events this week, right? And each day she spent 4 hours working on those events. Within QuickBooks, she's tagged 4 hours of her time to each one of those 5 projects, right? When the bill goes out to the client, inside those projects are 5 hours of your time at $30 an hour, $150. You've captured that. Now, what about the rest of the 4 hours of the day, right? Because those are the 4 hours I'm not working on the clients or the business. I'm working towards what Toby just talked about, operating the business itself. You can claim that expense too, right? And it has to have a dollar amount associated with it. But the question that I'm going to pose to you, is it tied to a product or a service or a project? Or is it just you, general operating of the business? And if it's just the general operating of the business, yes, you can claim that as an expense against the business.
Okay, so you're saying, you know, like the marketing and like organization of events,
Mhm.
for example, would be tied to each individual like event.
Correct.
Then say I'm doing like finance stuff, that's still
It's still
accounted for. But it's
correct.
just general operating.
It's just to general operating. Correct.
Okay.
Correct. And again, I'm actually, in this case, speaking specific to you,
Right.
because yours are project-based. Toby's might not be project. I mean, it sounds like Toby works with Amazon and Etsy, and so her time is spent working in those. that's still an expense to the business. I mean, she's there for 8 hours a day, plugging away, looking for new clients, filling orders, completing that is all a business. The only thing is right now, she's not paying herself, right? But that doesn't mean the business is not incurring the expense associated with her time, because we know her time has a value to it. Does that make
So
sense?
you create that value, you track the hours, and you categorize them based on whether it's operating the business or a certain project or
Correct.
whatever. And then you create the bill.
You're going to create an expense for yourself that's going to go basically go unpaid.
So then once you create that bill,
That's it. The
you don't
expense.
do anything for it.
Nope.
You don't have to.
You don't have to. I mean, eventually, ideally, you get to a point where you pay yourself, right? But you're still incurring the expense about the business. The only difference is you're not paying that bill.
Okay.
Does that make sense? Yeah? Yeah. Okay. Okay. So since my business has been open 18 months, is it all owning a business now? Yeah. In her case, it would be. So what kind of activities are not expensive that fall into the anything that does not pertain to your business specifically. So this is why I want to meet with you, Toby, and get a better idea of what it takes. So like if I was to use Sam as an example, your entire day is spent working and operating your business. You're just simply not compensating for yourself at this point in time. I'm assuming, Toby, that you're in a similar position, right? So as long as it relates to business activities, which is anything to do with your business, between 8 and 5 o'clock in the evening, maybe even longer if you own your own business, then yes, absolutely. So what kind of expensables that fall, building this in the category? So was everything I did to set up the business like, yep, absolutely, absolutely. The business license, the amount you have to pay local, the Secretary of State, the company that you utilize to incorporate you and make you an LLC, all business expenses. Captured in the year that you did it in. If it's this year or last year, when we meet, I can take a look at it for you. I actually own a bicycle shop in Pismo Beach. Oh, not Etsy or Amazon. Okay, even better. So you're saying, got it. Okay, got it. I think at this point, all my time is expensible. I would say so. Yeah. Even more so in your case, Toby, because I'm guessing you have a physical shop or a location that you're going to. And we haven't even touched on that. But the moment you arrive at work to the moment you walk out that door, there's a business expense. Yes. Oh, yeah. I'm going to have a ton of time talking to you about this. Yeah. The moment you get to work to the moment you leave, and anything that happens in between is an expense. You spend the whole day there, you drive down to SLO to meet with a prospective client. That travel, that's an expense. The mileage, that's an expense. The meal, that's an expense. Yeah, when you have a physical location, you do have the ability to incur a lot more. So here's another example, like your rent is an expense. The insurance associated with your property is an expense. If you pay property taxes on it, it's an expense. All these things associated with it are expenses. Did that answer your question, Toby? You good?
I have more questions, but they're not as much tax related anymore. So
Yeah.
I can see if somebody has any other questions.
Sure. Yeah, Toby, you and I are gonna have to sit down now that I know you're so close to here. We will make a plan to get together next week for sure. Okay, there we go. Let's see. Yes, I need to talk about all of that. I have a unique situation where my adult son runs the business on a day-to-day basis, and I live in. Great. I look forward to it, Toby. Fantastic. Okay, well, thank you everybody for attending today's session. Hopefully it was informative.
Yes, thank you.
Stick around so I can answer your questions. I will send out that follow-up email probably later on this evening or tomorrow morning first thing. Please don't hesitate to respond with any questions or concerns. Toby, I look forward to following up with you and meeting with you and discussing your business and taking it from there.
All right. Well, thank you, Damon, and thank you everyone for attending today, and have a wonderful holiday season, and we will see y'all in the next one.